Hello guys, welcome back to the second part of this video where we are solving the short questions from ISC Specimen Question Paper for Semester 1 2021-22 session year. In the previous video we had completed till question number 12 and here we are going to complete the rest of the paper, which are the remaining questions from 13 onwards. And the questions are really helpful for you to understand things at a concept level. If you know these things, then things becomes easy for you and you can do them quickly in the exam even if a small portion comes. Okay, so this sum is based on the valuation of goodwill where we have the profits given for the 4 years and we have the adjustments, and we have done the calculation to calculate the normal profit or loss for a given year. For the first year, the loss of stock by fire that has been already debited, so we have to add that back because it's an abnormal loss. Similarly, insurance claim is included here. That's an abnormal gain that has to be excluded. And then again, the voluntary retirement compensation paid, that is also one-off. That has to be added back. So the loss reduces here. And in the last one, the insurance premium, which is a business expense, that is not included. So that needs to be included. So the normal profit is total normal profit is coming to 1,60,000. Having done that, then we calculate the average profit here, which is straightforward. After you have done the calculation of total normal profit, the average profit is straight away 1,60,000 divided by 4, which is the number of years. So 40,000 is the answer for the first one. Number B, the value of goodwill. The question says that the goodwill is valued at 2 years purchase of the average profit. So whatever answer we got here, we have to just multiply 2 with that. So goodwill is 40,000 into 2, 80,000. Okay. And the last one is a conceptual question. Satvik is unable to bring in cash his share of goodwill. The account to be debited to record his goodwill compensation will be Satvik's current account. Okay. Whenever a new partner is unable to bring his or her share of goodwill, that is debited to the new partner's current account. Okay. So this is again, if you know the concept, things becomes easy for you. Moving on to question number 14. This is again, we have a sum scenario based question. This is on admission. So the first question here says, at the time of Kabir's admission, the workman compensation reserve, what will be the adjustment, right? So workman compensation reserve, as you can see in the balance sheet, this is given as 5,000. And here, point number 4, we have a liability on workman compensation reserve, which is 3,000. So as per the rule, you subtract this liability from 5,000. The remaining balance of 2,000 is distributed among the old partners. So 2,000 will be credited to the capital accounts of the old partners in their old ratio. So point number 3 is the answer, option 3. Number B, the value of land and building in the balance sheet of the reconstituted firm will be. Now, if you see point number 1 here, land and building is found to be valued at 25% above cost. It is decided to bring it to its cost price, right? So again here, this is a little tricky. Uh, you cannot do straight away that 25% of 25,000 and that gives you the answer, because you have to do 25% on the cost price. Okay, so the direct method is 25,000 into 100 by 125. That gives us 20,000 as the cost price of the building. Okay, you can use the X method as well, whatever suits you. Point number C, to adjust the creditors in point number 3, adjustment number 3, let's see. Creditors include an amount of 5,000 received as commission from Amar. The necessary adjustment is required to be made. So now this is commission, okay? Then that should not be part of creditors. So creditors to reduce. Creditors is a liability. If you're reducing a liability, that liability account is debited. So here option 4 is the answer. Creditors account will be debited with rupees 5,000. The journal is also given here. Creditors account debit to revaluation account. Okay. Number D. The provision for doubtful debts in the reconstituted firm will be. Now, if you look at the question, we have provision for doubtful debts in the balance sheet of 1500. Okay. And we have a bad debt of 1800. So this entire provision of 1500 will be used to write off this bad debt, and the question says the remaining debtors are good, so we're not creating any more provision. Okay, that's why the answer is nil. Nothing is left in the provision. This is the journal which is given for your reference. Provision for doubtful debts account debit 1500, revaluation account debit 300, to bad debts 1800. Point number E, the date of the balance sheet of the reconstituted firm. This will be the date of admission. So balance sheet as at the 1st April 2021. Okay, don't go for the option of for the year ending. For the year ending, we don't use for balance sheet. That's used for trading and profit and loss account. Balance sheet is prepared as on a particular date. All right, let's move on to question 15. Here, this is a forfeiture sum where 4,000 shares are forfeited, on which application money of rupees 3 had been paid. And out of these, 2,000 shares were reissued as fully paid up. Upon their reissue, the company transferred 4,000 to capital reserve. So our focus is on 2,000 shares. We are asked to calculate the rate at which these shares were reissued. That means at what price. First of all, amount that we have forfeited on 2,000 shares is 3 rupees per share that has been received. So 2,000 into 3 is 6,000. Profit made on reissue of 2,000 shares given already is 4,000. Discount which is provided on reissue of 2,000 shares is 6,000, which is the amount forfeited, minus the profit made. That means 2,000 discount has been provided on reissue of these shares. Okay. Issue price of 2,000 shares, which is face value minus discount. That means so 20,000 minus 2,000, 18,000. So these 2,000 shares are issued for 18,000. That means the issue price of each share is 18,000 by 2,000, which is rupees 9 per share. So option C is your answer. Okay, doing a simple back calculation that helps us. Question number 16. This is another scenario based question on company balance sheet. So here the issued capital of the company to be shown in notes to accounts as of 31st March 21 under share capital. Issued capital will be based on the number of times or total shares which are issued to the public, and in this case company has issued in two sets, 30,000 and 60,000. So that's why 90,000 into 10, 9 lakh becomes the issued capital. Okay. The next one is subscribed shares. Okay. So if you see here, for the first one, the people, the public applied for the full. And here, the second one, subscriptions were received for 55,000 shares. Okay. Now, out of 55,000, there was a defaulter of 1,000 shares whose shares were forfeited. So that's why minus 1,000. And then these out of these 1,800 shares were reissued. So plus 800. That's why 84,800 becomes the subscribed shares. The next one, the amount of share capital to be shown in the balance sheet of the company as at 31st March 2021. So we will be showing 84,800 into 10, which is 8,48,800, plus we have to show the balance of 200 shares, which are like forfeited shares, which are still with the company. And on this, 8 rupees were forfeited because the final call was not paid. So, which is 2 rupees. So 8 was received. 1,600 to be added. So 8,49,600 becomes the value of share capital to be shown in the balance sheet. And the last one is straightforward. The net gain made by the company on reissue of 800 shares will be transferred to, so any profit made on reissue of shares is transferred to capital reserve account. Okay, so option 2 is the answer here. Moving on to number 17, and this is really interesting. You have to use your understanding to solve this. Okay, we have journals of forfeiture, reissue, and capital reserve, and we have the share forfeiture account as well. The first one says the share capital account was debited with how much amount? Okay, so here this is the first journal they're talking about. So how to calculate that? If you see here, 7,000 and 4,000 that we have, plus, so 7 and 4,000 are added, minus 2,000, which is the debit premium. Now how do we get that? If you see here, we have share forfeiture account created, and if you look at the share forfeiture account, which is created by share capital 4,000, that means here we have 4,000. So if we get this one, 7 plus 4 minus 2 is 9,000. Straight away we get 9,000 here. Okay, so A is done. Second one, the shares were forfeited for non-payment of how much money, how much we did not receive. So if you see here, this is the narration this is talking about. So 1,000 shares have been forfeited for non-payment of rupees 9, including premium of rupees 2. Okay, so this is tricky because excluding premium we haven't received 7 rupees. Okay, so 7,000, but the 2 rupee premium also we haven't received. So the question is asking, including premium, how much was not received? Okay, so the answer is 9 rupees. All right, now again one question will come to your mind, how do we know premium is not received? You should be aware that during forfeiture, we can only debit securities premium reserve account if it is not received. So here 2000 is debited, which means this 2000 rupees has not been received against premium. Let's have a look at the next one, number C. Here we are required to find out at the time of reissue of shares, the share forfeiture account was debited with how much. Okay, so let's have a look. Share forfeiture account here was debited with how much? Okay, so if you look at the share forfeiture account, you will see that share forfeiture account is debited to share capital account 700 and to securities premium reserve account 1400. So these two amounts are comprising the share forfeiture amount here 2100. To clarify things and make things easier for you, as you can see, the shares are reissued at rupees 9 per share. There is a discount of rupee 1. Okay, on 700 shares, that becomes 700 here. However, now if you read the narration, these are reissued at 9 per share, but these are fully paid at 12 rupees per share. The initial face value was 10. So if these are fully paid 12 rupees per share, that means there is a premium of rupees 2 that has come into picture. And that's why here we are getting the additional 1400 as securities premium reserve, which is part of the next question. Moving on to the next question that we have, number D. At the time of reissue of shares, the share capital was created with how much? Okay, so as you can see, 700 shares are reissued at rupees 10 per share. That means the face value is 10. So 7,000 is created against share capital account. And question number E. At the time of reissue of shares, the account created with 1400 was it is securities premium reserve account as we just now discussed, because the fully paid shares, the value is increasing from 10 to 12. The extra 2 rupees is going as premium. All right, let's move on. So here the first one that we have is a ratio sum where we are required to calculate operating profit ratio of Gamma Limited. We are given the revenue from operations as 14 lakhs, gross profit as 9 lakh, Operating expenses as 75,000. Commission received 5,000 and profits from sale of fixed assets 10,000. Now for operating profit ratio, we need to calculate the operating profit first. Gross profit minus operating expenses. Okay. Commission received is not considered as operating. Profit from sale of fixed assets is also not operating. So this won't come. Our operating profit is 8,25,000 and operating profit ratio is 8,25,000 divided by revenue from operations 14 lakhs into 100, so 58.93 is our answer. The next one is very interesting question. Which of the following four companies is not deriving the benefit of trading on equity? Now, if you understand the concept of trading on equity, the company gets benefited, or rather, the shareholders get benefited from the amount borrowed via debt. Okay, so if a company is having low debt, that means they are not deriving the benefit of trading on equity. So Mars Limited is the answer here, which is having a very low amount of debt. 21 question number, another sum on ratio, trade receivables turnover ratio you are required to calculate. Now credit revenue from operations, we have it here as revenue from operations 12 lakhs, 25% of credit revenue from operations is cash. So again using the direct method, credit revenue is 9 lakh 60,000. Average debtors will be the sum of gross debtors and bill receivable, which is 2 lakh 40. So trade receivable turnover ratio is 9 lakh 60 divided by 2 lakh 40, which is 4 times. Okay. Again, one important point, provision for doubtful debts will not be considered here because for trade receivables turnover ratio, we do the calculation on gross debtors and not the net debtor. This is given to confuse you. Okay. So be careful. Question number 22. You're required to write the correct formula, identify the correct formula for computing earning per share. Again, remember net profit after tax and preference dividend by number of equity shares. Okay, be careful. This is the answer. And the last question, question 23. The current ratio is given to you. The quick ratio is given to you. And from the following transaction, pick the odd one out. Pick out the transaction which involves an increase in both the current ratio and the quick ratio. Okay, so you have to identify the item which impacts both the current ratio and the quick ratio. So goods worth 10,000 sold. So this is stock. Okay, and stock is not part of quick ratio, so not impacting that. Insurance premium paid in advance. This is prepaid. Again, this is not part of quick ratio, not impacting that. Plant and machinery is asset purchased for 9,000, so not impacting quick ratio, either of the ratio, not even current ratio, so not impacting that. And on the contrary, the if the cash is going out, this is not increasing, rather decreasing. Okay. So the last one, bills payable 2,000 honored on the due date. This impacts both of them. So this is the one which is leading to increase in both the current ratio and the quick ratio, because you're on one side the liability is decreasing and on the other side cash is also impacted. All right, hope this was helpful. If you have any questions, do let me know in the comments box below. I'll be more than happy to help you. If you really liked it and found it useful, hit the like button and do share with your friends. Stay tuned to this channel so that you don't miss out any future videos, and also hit the subscribe button and the bell icon to get notified whenever a new video is dropped. Thanks.